Known for his wisdom and successful track record in the stock market, Warren Buffett has much to teach us about making smart investing decisions. Buffett's investment holding company, Berkshire Hathaway, has done a near impossible 30,000 times return rate since it began. He owes that success to a few key principles that he never forgets. So, let's dive in and see what pearls of wisdom he has to share with us. Here are the 7 things Warren Buffett thinks you need to know. Mr. Buffett is a big fan of understanding and exploiting the intrinsic value of stocks when investing. Simply put, intrinsic value refers to a company's perceived or calculated value based on its fundamental characteristics. It determines whether a stock is overvalued or undervalued in the market. Mr. Buffett has explained his method for calculating intrinsic value thoroughly, giving insight into how you can make foolproof investment decisions. An investor can use various methods to calculate intrinsic value, like the discounted cash flow model he mentioned, which considers the company's future cash flows and discounts them back to their present value. Other factors that you may consider in determining intrinsic value include the company's earnings, dividends, assets, and growth prospects. The intrinsic value of a stock is not necessarily the same as its market price, and an investor may believe that a stock is undervalued if its intrinsic value is higher than its market price. An undervalued stock heralds good news for investors looking for stocks that'll appreciate once the market realizes its true value. It's important to note that determining intrinsic value is not an exact science, and different investors may have different opinions on the intrinsic value of a particular stock. When it comes to the stock market, volatility is the name of the game, and it has been since the beginning of time. Volatility refers to the rate at which the price of a security, such as a stock or bond, fluctuates over time because of various factors. These factors could be economic or political events, natural disasters, or changes in investor sentiment. Here's what Mr. Buffett has to say about volatility. As you can see, Mr. Buffett is an avid lover of the market's volatility. Warren Buffett views volatile markets as opportunities to buy stocks at good prices. He believes that stocks, while more volatile than cash or bonds in the short term, are a safer investment over the long term. Therefore, he advises investors to embrace market volatility and consider it an opportunity rather than a risk. Some investors may be attracted to volatile markets because of the potential for high returns, while others may avoid them due to the risk of significant losses. What can we say? Investing is a roller coaster ride. Humans work with emotions, among a dozen other factors involved in decision-making. However, as an investor, your emotions must take several seats if you want to stay on top of your game. Emotions can often cloud judgment and lead to irrational decision-making. In investing, this can cause investors to decide based on fear, greed, or other emotions, rather than on sound analysis and logical reasoning. Yeah, you made a lot of money last year during the bull market, but should you let your greed for more push you to borrow recklessly or make hasty decisions? By focusing on the facts and avoiding emotional decision-making, investors can make more informed and rational choices about their investments. This may involve conducting thorough research, staying up to date on market developments, and considering multiple viewpoints before making a decision. By basing investment decisions on facts rather than emotions, investors may be more likely to make sound, long-term investment choices that are less prone to the influence of fleeting emotions. It can be tempting to follow the herd and go with whatever is trending and making good money. Sometimes this can work in your favor to make a quick buck, but you'll find it isn't sustainable in the long run. Investors need to stick to what they understand when investing, because it can help them make informed and confident decisions. This is called the circle of competence. When an investor has a basic understanding of the economics of a business,
should expect to make money in things that I understand. And when I say understand, I don't mean understand the product does or anything like that. I mean, understand what the economics of the business
and how it fits into their overall portfolio. They're more likely to assess the potential risks and rewards of the investment properly. This means they'll make better decisions based on their informed and thorough analysis, rather than on opinions and wishful thinking. On the other hand, if an investor doesn't understand an investment, they may be more prone to making decisions. By sticking to what you understand, you can increase your chances of making successful investments aligned with your goals and risk tolerance. You tend to feel more confident about your decisions and can better withstand potential market fluctuations because you understand them. You reduce poor management risks, and you can reduce unnecessary stress and frustration by not understanding your investments. Back in the 1940s or 1950s, Warren Buffett's mentor and fellow investor, Ben Graham, taught him something that didn't quite work well for him. For a long time, Mr. Buffett picked up a large quantity of practically useless stocks just because he prioritized quantity over quality. While this might work for a few lucky investors, you're more likely to get burned, and Mr. Buffett strongly advises against it. While diversification is generally considered important in investing, there's also a thing called over-diversification. Having too many investments can make it difficult to invest and manage risks properly. By focusing on quality investments rather than quantity, you can create a well-diversified and balanced portfolio with a smaller number of good quality investments. Don't be so carried away by the cigar butt stocks on the side of the road that you miss the full packs waiting for you in plain sight. Warren Buffett believes it is essential to seize big opportunities when they present themselves, as they only come around sometimes. He advises approaching financial decisions with caution and care, as if you only had limited investment opportunities. Treating each decision as valuable and scarce can increase your chances of making successful investments and achieving financial success. He explained this better using the 20-punch card analogy.
You're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it.
Buffett suggests avoiding impulsive decisions, such as buying a company's stock simply because you heard about it at a cocktail party and someone made money on a similar investment. Instead, he advises thoroughly evaluating each opportunity and considering all relevant factors before making a decision. By following this approach, you can increase your chances of making informed and successful investments over the long term. According to Mr. Buffett, it's important to approach investing with a long-term mindset, rather than focusing solely on short-term price movements. In his opinion, if you aren't willing to hold a stock for at least 10 years, you shouldn't even consider owning it for a shorter period of time.
You buy it knowing there's 365 days a year.
He buys stocks with the intention of holding them long-term, rather than simply looking for quick price appreciation. While he does sell stocks occasionally, he generally tries to approach most of his investments with a forever mentality. If you are unable to adopt this perspective, Buffett suggests that a set-it-and-forget-it investment, like an S&P 500 index fund, may be a good option. There are many reasons why investors should consider taking up the long-term approach to investing. For one, market fluctuations in the short term can wreck your portfolio and confidence as an investor. By thinking long-term, investors can weather short-term market downturns and potentially achieve better investment returns over the long run. You also get to compound your interest and diversify better when you play the long game. It's important to note that thinking long-term does not mean avoiding all risks or being overly conservative. Instead, it's about finding a balance and considering the long-term prospects of an investment in addition to short-term fluctuations. We hope you enjoyed learning about these 7 valuable investing rules from Warren Buffett. Following these principles can increase your chances of making informed and successful investment decisions. Remember, investing is a long-term pursuit, and it's important to approach it with a clear strategy and a focus on the fundamentals. Thank you for watching, and don't forget to like this video and subscribe for more. See you in the next one.